Our next guest says, do not fear the sell-off this week because the bull market is not dead. Let's welcome back Jeff Mills, PNC Financial Services Group and co-chief investment strategist. Great to have you back, Jeff.
Good to see everybody.
We've got a lot of doom and gloom on this desk here tonight.
Yeah,
but you say new highs are coming this year. So what drives us to new highs?
Yeah, look, I think where we are today, we were bound to get here, right? I mean, there was no way we were going to sustain the momentum that we saw in January and February. And if you just look at some of the complacency that was building up under the surface, I mean, the put-call ratio collapsed. Bulls to bears started to expand again. And if you extrapolate from the options market, what that was pricing in from a sentiment perspective, you can back out the probabilities for different market moves, so 10% higher, 10% lower. Options market was pricing in the probability of about a 7% probability of a 10% move lower. So that's only in the 32nd percentile of observations over the last 5 years, where if you look at a 10% pop, pricing in a 3% probability. Now that's lower, but that's in the 62nd percentile over the last 5 years. So that's tilted to the bullish side as well. So I think ultimately that complacency needs to come out and the market needs to be doing what it's doing.
Can you believe what you believe, and that is the markets will hit new highs this year, and also believe what they are saying in terms of their outlook eventually for global growth and the U.S.?
So here's what I think is being underappreciated a bit. And it's only early days here, but it's starting to smell to me a little bit like 2015, 2016, where global PMIs were rolling over. Earnings growth was decelerating. Everybody was talking about potential for a global economic recession. All of a sudden, China steps in from a credit growth perspective. The global economy reaccelerated and markets reacted positively. If you look at what China's been doing from a stimulus perspective, the credit growth numbers out of China in January were big. 3.2 trillion yuan lent by financial institutions, the largest month we've seen since 1992. I actually brought a chart along with me. They said they could throw it up on the screen, but it actually looks at the Chinese credit impulse versus manufacturing PMI. This is versus the U.S., but you can map any region to it, and it probably looks similar. So with a lag, that increase in the credit impulse over a 6-month period actually will bring PMIs up with it. So it looks like it's bottom. So maybe halfway through this year, you start to see a stabilization.
Right. So, Jeff, when you look at China, though, China has tried over 50 different stimulative measures. None of them have worked.
Over what time frame?
Over the last year or so, basically?
Yeah, I think it's into the 60s now, actually.
Yeah, all right. So in the 60s, nothing has worked. And back to the point you're talking about, the ECB had a whole bunch of bullets left. They were putting massive stimulus on. They don't have it anymore. How can it be 2015, 16?
I go back to the China credit story.
But it's just China. So if China doesn't work, then it's all
I think
all else fails.
that's a big part of it. And you've heard Draghi say in some of his comments that internal demand is actually decent in the Eurozone. He mentioned a lot of external demand issues as it related to China and EM. So those credit numbers were big. And if that's any indication that Chinese stimulus is going to work, then I think you could see maybe not a reacceleration like 2015, but at least a stabling out of global growth. And I think that removes the fears of a potential economic recession globally. And if you think about what has happened with U.S. earnings, so look at companies like Apple, Micron, NVIDIA, just those names alone have led to almost 40% of the earnings expectations deceleration in the first quarter. So those companies have huge revenues exposure to China, 20% from Apple, 50% from the other two names. So if you start to see some stabilization there, some of those names increase expectations, and I think that puts some support under the market ultimately.
So markets in a Fed tightening cycle, we see multiple contractions. So we're not in a tightening cycle anymore, so we think. And you back to 2015, 16, markets traded a high multiple. I totally agree with you. What's the multiple here?
Yeah, I mean, that's the question, right? You can back into what I think is reasonable earnings. So I think you talk about 4% revenue growth that kind of converges with nominal GDP. You get 2% share count coming out of the market from buybacks. It gets you to about 6% earnings. So then what is the correct multiple? I think we can maintain the multiple turn higher that we've seen. I think the Fed probably priced in, a trade deal probably priced in, and things have to go right in that regard. But I think you can maintain the turn higher. I think those risks have been justifiably priced out of the market. So you take 17.5 times on trailing earnings. You say we get to 172 this year. That gets you to 3,000 by the end of the year. Things have to go right, but I think that's a plausibly optimistic scenario right now.
All right, 3,000. Jeff, good to see you. Thank you.
Thanks a lot.
Jeff Mills, PNC.
Let me tell you a big difference between 2015 when we did have that global growth scare. Taking linking it back to the U.S. stock market, what really outperformed? It was FANG, MAGA, whatever you want to call it, you know what I call it. Those stocks, people were crowded in because they weren't as dependent on this notion of kind of global growth. It's really interesting to me right now that that group of stocks is kind of sitting out right now. And then the other one, and we talk about it a lot, and I know you guys like the banks, the U.S. banks here, they're so much better levered than they were, this and that, whatever. You saw what happened in Europe. You see what's going on with these banks. We've seen banks in EM. It's a real disaster right now, and our banks just can't rally. So the fact that we have FANG, MAGA sitting out and the banks are just stuck in the mud.
But this week we've been talking about FANG's been coming back, and that actually these are the things that could. Maybe you haven't been.
No,
but the point is
last week
this conversation is all over the map, isn't it?
No, but what I'm saying, what did I just say? Back in 2015, there was a lot of money that was hiding out in mega cap, expensive U.S. tech growth, okay? They're not doing that right now. So to me, I think that's a big difference. And the fact is, if you were to see some sort of reflation, you would see our banks acting much better. And when you look at the Euro Stoxx Bank Index trade away
I hear you talking about our banks like they're European banks. It's not even close.
I'm not.
I mean,
Tim, I'm obviously not. What I'm saying is here, they're not participating. And it's kind of troubling when you see, the outperformance in other more cyclical areas that may not get what they need from, this trade that was supposed to happen when we got a Chinese trade deal.
Okay. Well, I simply would say I don't think our banks have really participated in the rally for much of the last 15 months, and I don't think that's an indictment.
So what's happened to the market for the last 15 months? It's gone nowhere. You know what I mean? So what I'm saying, I'm not saying we're crashing anytime soon because Citi can't get above $63 or JP Morgan can't get above 108. What I'm telling you is that we may be in this range, that 29.30 on the upside to 23.50 on the downside for some time, and we may not have any answers to all these questions that we try to answer every night here.